Hey, good morning, everybody. It is Mike, and it is Saturday morning, Multifamily Unplugged, where you get raw, unscripted conversation. None of this is ever scripted, and we're here to bring you the most relevant content that we can with some exciting guests. And this morning, I'm just going to say it again, buckle up because you're in for a ride. I got to share the stage last week at the GOB multifamily conference in Chicago with a couple of gentlemen that just blew me away with the conversation. So I'm joined today by Patrick Grimes, the CEO of Invest on Main Street. But before I get into that and bring him on, I just want to remind you, first of all, grab your coffee, sit back. You're going to enjoy this ride this morning. If somebody that you know needs to listen in to this morning's show, go wake them up, stick a cup of coffee in their hand, go let somebody who doesn't know about the show know about it, and follow us here today because you're in for a treat. Remember, I always talk about intentions. What are your intentions? So are you getting up every day? Are you being intentional about your journey, about your multifamily journey? About building your business? Are you taking the action steps? You know, we can get all the education in the world and we can do things that are going to help improve us personally as well as professionally. But unless we take that step forward, and we're going to talk to Patrick today about taking that step forward and what that was like for him when he first got started. So I want to just encourage you to be intentional every day. You know, what is it in your daily routine, your daily disciplines? Do you get up? Do you pray? Do you meditate? Do you work out? What type of time do you spend for yourself, building into yourself, and then setting up your day, setting up your week? And I just continually want to encourage you to do that. You know, the only way I got my book written was because I spent the time every day that I needed to pencil out in order to do that. And really, you know, that's about being intentional. And I want us all to be intentional. One thing I'd like you to be intentional about right now is if you're following us on YouTube, please subscribe to the channel. You're going to find all kinds of content every day coming up. Follow us on the social media platform that you get your fix from, whether it is LinkedIn or Instagram or Facebook, wherever you are, you'll find us, you'll find me. And please follow me, like me, love me. You know, it helps. So I appreciate that. So I'm joined today by Patrick Grimes. Patrick Grimes is the CEO of Invest on Main Street. He's joining us today from Newport Beach, California. Someplace I'd really like to be is on the beach, not in Newport, but maybe down in Laguna. And we're going to talk about apartment syndications. We're going to talk about markets, and we're going to talk about how to raise private capital. So let me bring Patrick in. Hey, good morning.
Morning, Mike. I'm excited to be here. I really enjoyed our panel in Chicago, stimulating conversation, and I'm glad that we're able to continue to connect.
Yeah, me too. I really kind of felt a bond with you and Jay, actually. Jay's going to be on the show in a couple of weeks, so I'm excited about that. And it's, you know, it was an interesting event, that's for sure. So you got your coffee?
I do. It's right here.
Perfect.
Right in my Ember mug that keeps it at a plus or minus a quarter of a degree or so.
All right, good. Well, let's roll. So, hey, the first question I ask all my guests, and you know, I've been talking about this a lot lately, is I'm going to write a book one of these days. I'm going to go back in all my episodes, and I'm going to ask that question and write a book about it. And it is, you know, what's the one word that best describes you personally and professionally?
The one word. Well, and it's interesting. I was just participated in a book on the topic, and persistent would probably be it. Maybe if you ask my wife, a little bit to a fault, but it's certainly been an advantage on the professional side.
That's awesome. So tell me what makes you persistent.
I think I tend to go for goals. I even through the trenches. I worked full time and I did 2 master's degrees, for example, right? And I was determined to make it in high tech. I spent 2.5 years trying to pivot from single family to multi. And when I finally got into my first deal, took a lot of persistence to get there, but you know, staying focused on that goal and making it happen.
Yeah, that's awesome. And you know, if I had to ask you today, what are you being persistent at?
So right now I'm being persistent at getting my name out there. As an engineer, it's a little uncomfortable by trade, getting out in front of everybody. And I've pretty much done all my deals, keeping my head close to the grinding wheel and getting the work done. Now I'm working on podcasts, writing for Forbes, got a book, getting my story out there, doing this with you, sitting on panels. That's all new for me.
Yeah. So we're going to talk about your book, and I know you're going to give it away, give a copy away at the end of the program. So I'm excited to hear about that. So Patrick, why don't we do this? Let's back up in time a little bit. Tell us a little bit about you and, you know, your history and how you wound up getting in the multifamily space.
Sure. So it kind of got to dial back to, I was kind of as a young tyke, I was an inventor, constantly building and designing things, which led me into engineering school. And it started out right off the bat and doing machine design, automation, and robotics. Loved it. I'm a huge geek inside, love the numbers and the design side, the creative side of it kind of all blend together. But the owner of the company I was working for at the time challenged me and said, hey, this is a lot of fun, but innovation, product development, and high tech is very volatile, and it's not going to provide the future that you want and the economic stability you want for your family. Invest as early as you can and as much as you can into real estate. Well, I took that to heart, dumped as much as I could into the highest returning deal, not really having a lot of thought for risk, and being so young, wasn't really considering that side. And being 2006 when the market was never going to go down, and I dumped it into some pre-development, more speculative, going to build and create a residential community, and then rode that down, personally guaranteed it all. And that's really what set kind of the stage for the ultra conservatism and study in economics and recession resilience, markets, and how to invest more calculated and low leverage. That kind of reflective of my future career at that point.
So you bring up a word that I love, and that's economics. Did you study economics in school, or is that something you did after 2008?
I never took a macro or microeconomics course. I don't know how I would fare if somebody put a test in front of me. I do have an MBA and I do have a master's in engineering, but and a bachelor's. But in the world of real estate, we are studying macro and microeconomics in focuses, right? In support of the business plan, everywhere from the diversified jobs to the shift of the markets, the shift of people, and how the rates are constantly changing, and how to structure deals in a way where they'll withstand the test of time. You are a little bit of an economist if you're a responsible real estate investor on the scale that we are. We're closing on deals, hundreds of units at a time.
Yeah. So let me ask you this: where are you getting some of that data from, some of that information from that you're studying, that economic stuff? Is it a certain economist you follow, or is it data that you're going and getting? And do you spend an amount of time throughout the week studying that, or, what do you look, how do you work that in? Because I was impressed sitting next to you. I actually felt a little sheepish because you guys talked a little bit above, some of the things that I look at, and I think I look at a lot, right? So where do you get that information, and how much time do you spend studying?
Well, it's interesting you say that, Mike, because I felt the same way about you, right? You've obviously been through the gamut for longer than I have, and you have a lot more experience than I have. But, I follow quite a few people on LinkedIn as well as Facebook that are hedge fund, alternative assets in the debt markets that are constantly putting out data. Fred, I've been using since 2006. And that data anybody can go to, that provides the trends of interest rates and home values and migration, net migration, home income. All the federal data is available that we can, and I plot it frequently. About every week or so, I'm looking at other deals and I'm looking at markets, and I'll plot the median household income, the unemployment rates for different markets, and I'll make comparisons. And I'll do that when investors call me and be like, hey, I'm looking at this other deal. It's in a Phoenix or a Tucson. How does that compare? Well, diversified employment, hospitality, those ratios took 12 to 14 years for some of those to recover when compared to Houston, where it leveled off for a few handful of quarters before it started climbing again. And those are things you just got to kind of go with the territory, some of the more boom and bust markets. And so I'll follow that. Try and think of other sources. It comes from a lot of different sources. The commercial markets are obviously something I'm constantly looking out for. Marcus and Millichap has a bunch of really great data on their forecasting. Looking at the expansion, hyper supply, recession, recovery curves of all the markets. There's a handful of reports out there I get in my emails. They're kind of a lot of stuff, but I tend to be a little bit of a data nut, so I'm attracted to that kind of information.
Yeah. And, you know, I guess it helps you too when it comes to underwriting and making a decision about, is this a market and does the property make sense in the market? I like what you talked about, diversified employment, because when I look at back in 2008, when the world turned upside down, you know, I was heavily vested in the Ohio Valley, for instance. In the Ohio Valley, you know, it's car manufacturing, but not the car itself, but the parts for cars. Mm-hmm. So little businesses that make knobs for radios or springs for seats, and, mm-hmm. you know, then transportation. And we got hit pretty hard in 2008 when those markets went upside down, and they really struggled, right? So I like the diversified employment look when we're looking at the traps, you know, the population growth, the job growth, the household income. I think that diversified employment is something that we need to work in a little bit more, and everybody probably really needs to talk about that a little more.
Yeah, so data.io is one of the ones that I use that has it has some incredible employment numbers. Every single investment deck I've ever done provides the pictorial graph of here's the healthcare, here's the technology, here's the manufacturing, construction, finance, logistics, and then hospitality, and then retail, right? Yeah. And then how balanced are they? And then that kind of shows a makeup. But if you're 20% in oil, like some cities used to be way in the back, or, you know, even greater in automotive, which was a Detroit, you know. Right. And to your point, when the air industry took a big hit, all the secondary and tertiary suppliers of Boeing, you know, there were some big suppliers in places like Portland, which took a big dive, right? Yeah. And so you got to find those areas which not only are weighted in the type of jobs that they have, but then if you look at the big employers in the area, it can't be all education. It can't be all one military base, because once they're gone, you can't enforce those leases. It can't be all one big plant, right? Or all high tech. I mean, one of the biggest losers right now on population and yield is San Jose. A lot of those high tech jobs turn out to be fleeting, and they're moving to Phoenix and other locations. But you're taking a large proportion of those kind of fleeting, risky, not as stabilized logistics and manufacturing type of jobs, not are in healthcare, and you're kind of putting them somewhere else. Well, does that make it a stable economy, or does that make that economy balanced, right? Those are the things you really got to look at. And it's not that complex from a syndicator perspective, because we can see overlapping what has happened in the past, what kind of employment makeup supported that, and what does it have today. And that reduces us down to just a number of markets that are also landlord friendly and tax advantaged, so we can have very stabilized income, and we'll continue to attract employers. That reduces us down to a few different markets, and those are the ones that I choose to play in. Yeah,
interesting. So data.io, is that a free free website?
Yeah.
Mm-hmm. Okay. All right. Interesting. Good. So I hope the listeners wrote that down, because I know a lot of times we slip things in, and if you're not taking notes, they kind of forget. Hey, let's talk about asset classes for a minute. So you're a multifamily guy, but you mentioned retail and office, and, you know, what do you like as an asset class now, you know, considering that we're making this shift in the marketplace, and that we're heading into, you know, we're in this recession, right? They're not calling it that yet, but I'm sure they will here soon. And, you know, as we start to cycle through this thing, what do you like as an asset class? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
Well, so in my space, I tend to be very narrow because nobody in my family or my career said, hey, it's multifamily. That's the way. I started residential development, tried single family, buy, distress, renovate, hold, realize that there's risks associated with your vacancy, troubling your cash flow, people moving out, trying to manage property managers, all these things, and people fleeting out of areas in single family. I struggled with that for some time, and then I kind of picked up a bunch of courses, read a bunch of books, and they're all kind of lamps that led me to all kinds of different things. I looked at assisted living's got a bunch of buzzwords. Airbnb's got a bunch of buzzwords. Those are kind of living on the fringe of some laws right now. Investing in some, just like the startups, like investing in Airbnb or investing in Uber or Lyft. And there's some fringe right there on legislative risk associated with those. And then you look at the financing is not as favorable for some of those assets. I started looking at, mobile home parks and self-storage. Well, those are also very popular, but self-storage, in my opinion, is not an essential need. I kind of deal with some of my partners on it and say, well, you know what, before I lose my house, I'd rather lose my garage, and I'd rather move my stuff out of storage and put it in the garage.
Yeah.
And that's my perspective. Not everybody thinks that. They're saying, oh no, when you lose your house, you have to keep your storage because you're going to downsize. Well, maybe, but I would rather sell the storage and lose my house to begin with. So the essential need conversation can shift, right? And so if you're looking for downside protection and you're structuring a deal to survive a reset, like what I'm assuming is going to happen every year, because we've had consistently what could look like a bubble, where I want to be able to ride out a reset, but I'm not going to sit on the sidelines and lose money with inflation. I'm looking at workforce housing, which existing construction, not new development. Obviously, that took me down before, but workforce housing that you can buy under market, that's distressed. You got to work real hard to find those, right? B and C class, meaning 20 to 50 years old, not the oldest, what they call class D, where their disposable income is razor thin and small changes in inflation or job loss means directly not being able to pay rent. They don't have a lot of savings either. And not A class existing construction, because you're being top dollar. They don't really allow for low break-even occupancies or high vacancy rates and still pay your bills because it's so expensive more recently to build new than it was before to build. So there's a moat between our rents and theirs. So I go for workforce housing, multifamily. And I have stuck true to that because it does fall into kind of this gamut of different things that point towards, as long as you structure it correctly, a haven for where the wealthy have stored their wealth for centuries, right? When done right. And that's a big when done right? That's something else.
Yeah, interesting. So if you had to say, describe your buy box, what does your buy box look like right now in that workforce housing multifamily space?
Yeah, well, it's deals that, and there's I call it the 10 different factors. Now we're talking about emerging markets where job, income, population growth, but in the right kind of jobs that are diversified, the right type of legislative risk or landlord friendly. So you're looking at the Texas, you're looking at Georgia, you're looking at Northern Southern Carolinas, Florida, a little bit in Cincinnati and Ohio. But once you kind of overlay those, call it macro and then some microeconomics, you got to look within those markets for
Right.
What's the path of progress? Where are new construction being built? Because you want to build where the rent ceiling is going to lift over time. And then you got to find the right deal. Like I said, 20 to 50 years old, one that is trailing rents by 200 to 500 a month from the nearby comparables. And you can do a quick observation to see, oh, those nearby comparables, well, they just have these amenities and these interior renovations, so we can lift to there. And if you can find 3 or 4 of those, you can paint a really clear picture. If we renovate to that level, we can charge these higher rents. And that's what we're aiming for. And as long as you can pencil at very low leveraged, and you can fix your interest rate and buy rate caps or lock in debt for that over a long period, so that your break-even occupancies that you're allowing for, the vacancy you can allow for, is well below where it fell in the past market cycles, then you've got a deal.
What does low leverage for you today look like?
Right now we're at 68% loan to cost, and I look at loan to cost as our loan compared to the entire cost of the project. Okay. If you just look at loan to value or down payment, where your down payment is 25 or loan to value 75, what maybe the syndicator is not telling you is, oh, we're getting a second loan for all the construction costs. Well, the actual loan compared to the total price, right, becomes important of the deal. So we're looking at that. Really, what I'm targeting is 75% or lower break-even occupancies, meaning the vacancies can drop to there, and we can still pay our bills.
So, so I just want to be clear with the listeners. What Patrick talked about there was loan to cost. Loan was against the all-in cost. So when we talk about all-in cost, that is our purchase price, our construction capital, our closing costs, any fees or operating fees that need to go into there. That's your all-in cost. So when he talks about loan to cost, that would be, you said 68% LOC.
Yes. Yeah. I mean, that's our current deal right now. We're in some deals we've been at 55, some we've been at 60, some 65. We're at 68 right now.
Yeah. So in the capital stack, and so people understand that capital stack is how we stack the money that we bring to close the deal, to operate the deal, and that's your debt, your private equity, any bridge funding, any construction costs. In your capital stack, you're getting a primary loan for your purchase. Are you getting loans then to do the construction, or are you raising that capital from investors? How are you doing that?
Yeah, that's a really important question. And it's something that all the passive investors should ask, because typically what is only thought about is that primary debt component, right? Your loan. But then on top of that, we have closing costs, right? Which come out of the fees necessary and the acquisition fee. On top of that, you have your repair and reserves, which your reserves, we raised another 6 months worth in capital to pay our expenses for 6 months. That's like an extra $1 million on top, which is a safety net. And then on top of that, we'll raise all the improvements. So we're not getting a second loan for the improvements. We're not trying to get a second loan in the case that we need any emergency funds. We raise all of that up front.
Right. So like the last deal we did, we paid $4.6 million for the property. It was 40 units. And then we went and raised about another $700,000 to cover all those costs and closing costs and things like that. Hey, let's talk about this real quick, because the conversation at the GOB conference talked a lot about the cost of capital today. So your debt, the interest rate on debt being higher than cap rates. And talk a little bit about the dynamics around that. And I want the listeners, because we have a lot of new people that listen in, but I want the listeners to listen to this, because I think it's really important that you understand where the market's at right now. And when you look at that the cost of your capital, the cost of debt versus where the cap rates are today, because we have such a compression in cap rates. But then on top of that, when you bring the private equity component in, and you might be paying a 7 or an 8% pref to your private equity investors, how does all that shake out in your world?
Well, I think that there's a couple components, and our third panelist is the one that dove into there, and he went as far to say that currently today, getting debt is cheaper than raising, getting equity, raising capital is cheaper than actually getting a loan.
Right.
Now, and so he said, well, it's better to raise more equity now. And than it is to get those loans. As those loans increase, your cost of that capital grows, right?
Right.
If it gets 6 or 7% from a cash flow basis, well, our investors are expecting cash flows that are similar, right? So at one point, it just becomes comparable. When we were getting 2 from the debt or 3 from the debt, and our investors were expecting, a 4, 5, 6, 7, 8 cash flow, but we know that the debt is fixed at 2 or 3 over time, but the investors are expecting their cash flow to go up. Well, it's better to get a higher debt, right? Because we know that cost of capital in the long haul is going to be lower. He's not talking about the exit, but he is talking about cash flow, right? Cash on cash return. And so what his claim was, now today, it makes more sense to raise it. The economics are now where it's approaching making more sense to just raise equity, which means those guys that were potentially getting really high debt, very, very high leverage. It doesn't make sense for them to do that anymore, because now it's a win-win. You get more equity, you have lower debt, and you're not paying as much to a primary debt component, which is riskier because they're going to take the first penny in, whereas the equity is not as risky because they're going to take whatever's available.
Yeah.
Right. So your risk goes down. So that was his claim.
Right.
On the other side, which I'll probably state, right, that that I'd bring up, because of in an inflationary environment, the cost of debt goes up. So the sooner you lock in debt today, the better buying power you have tomorrow with that debt. That debt becomes an asset. So if you're locking in, like we just locked in a 3.25% interest rate on our 372 units in Houston. Well, now they're at 5.25% of 6.25%, right? But over time, that debt, because in the value of those dollars as inflation goes up over time, that debt basically reduces, right, itself just by inflation. So I'll make the argument that if you can lock in lower term debt, do it right away, buy right now, because as inflation starts to go up, that is inflation reducing the amount of value of that debt. So over time, that debt, it becomes easier and easier to pay off. And so that's kind of like the two sides to it. You can say that the cost of capitals are approaching from a cash on cash perspective, but at the same time, the debt that you lock in today is cheaper today than it will be tomorrow. Does that make sense?
Yeah, for sure. It's pretty heavy for Saturday morning.
Yeah, it is. Yeah. I think the panelists challenged us to make it a little more straightforward. And I did write an article in Forbes where they also pushed me to make it on inflation and how multifamily can be a hedge against inflation. That does break it down in a little more simple terms.
Why is it a hedge against inflation?
Well, so I make the argument that rental property in itself is amongst the best hedge against inflation if, again, it's structured correctly, if it's existing construction, low leveraged, and you're fixing in long-term debt. And the reason why is, for example, just running some very simple numbers, if you're collecting $100 in rent in our multifamily properties, well, we only pay, our expense ratios are only half, right? So if our expenses go up, it's $50 in expenses. If it goes up 10%, then that's a $55 expense bill. But if our rents go up with it, then that's 110%. That's 110. Well, we went from $50 in cash flow to $55 in cash flow. So in a scenario in which inflation grows rents and grows expenses at the same, it actually produces more income if the debt component is fixed. Now, that doesn't mean that rents will go up with inflation necessarily. but it means that our rents only have to go up half the rate of inflation to even break even. So if we're not producing twice as much, I mean, if we're not growing at exactly at the rate of inflation, we're at least a hedge. But as long as that we're in an asset that allows for the disposable income, that allows for the ability for rents to grow, then you can actually win big by both the spread between expenses and rents growing, and also what I described before, where the debt as inflation grows actually becomes easier to pay over time. Right? The debt itself becomes a valuable asset to you that the buyer of tomorrow can't buy at that price. Right? So for those two reasons, they tend to be a hedge in an inflationary environment. Now, if nobody has jobs and they can't pay their rent, that's different. But where are you going to put your money? You have to put it somewhere. You can't lose it 8% a year in your checking account, right? So where are you going to put it? Well, you should probably put it where people are storing their cash, very low risk, low leveraged workforce housing projects where you could potentially win or at least hedge with inflation.
Interesting. Well, lots said, that's for sure. And I really I'm going to encourage people to go back and listen to this a couple of times, because there's a lot here. And if you really want to get, clear on where the market's at, where the market's going, and how you play in that market, definitely go back and listen to this, because there's some good information in here. Patrick, let's talk a little bit about you, how you sit on your team. What do you do? Are you the analytical, part of the team? Do you do the underwriting? Do you look for assets? Do you raise capital? What part do you play?
So my jobs have focused in different areas over time. I think I was doing a whole lot more of the underwriting, deal finding, broker relationships up front. Now we've got people to help out with that. I've brought partners on as well that have pretty much a lot of that handled. I'm probably more involved in maybe the capital raising and asset management side, I would say, than I am in the deal sourcing at this point.
Okay.
By the way, it is datausa.io. I think I said data.io, but it's datausa.io.
Okay.
And you're going to see all the metrics of all the employment. By the way, I forgot to mention
that. Okay. Perfect. Thanks for clarifying that. So what are you currently working on?
So we have a property we're just about to close in Atlanta, 284 units, got it at a 4.25% interest rate. Wow. Capped it at 5.25%, which is awesome. So that'll be a great asset, and stress tested at 8.25%. So we're a long ways away from any interest rate being a risk for us. Got it under market, off market, lots of upside. Really excited. Have another one coming up in Texas that is just around the corner that we just got a huge discount on. About $1.5 million discount on, which we're excited. It's probably even going to be higher returning than the one we're working on right now. So we can still buy when structured correctly in the right markets with the right leverage and the right interest rate protections. There's still amazing deals out there.
Yeah, interesting. You like it, Atlanta? Is that your primary focus, primary market?
No, I would say Texas has been my primary market. Texas, but Georgia, Northern and Southern Carolinas, one in Florida, but in Jacksonville, Florida, where it's got a diversified employment. You'll see that, unlike the hospitality focus. And then a couple in the Midwest. I think part of being healthy, having a healthy portfolio for our investor base and our company is to buy in multiple areas that allow for some diversification. Some are higher appreciation, some are higher cash flowing, all in emerging neighborhoods and diversified employment with growth. But so we are actually focusing on building out a diversified stream of cash flow that our investors can rely on over time.
What do you like in the Midwest?
Well, so you've got to play a little more of a higher cash flow play. So it kind of balances out. In a 7 cap, we were able to find a portfolio of properties. A 7 cap is astronomical. I mean, that's like something from the Stone Age, from back in 20 years ago, right? It's hard to find stuff like that. So, but yeah, that means cash flowing on day one, above 6-7%, just very hard to do, but immediate appreciation through renovations, where this portfolio was bought by a guy who had just built it together over some years in Cincinnati mostly and Columbus, and wanted to just offload it all, and we were able to get it off market. Traditionally wouldn't be involved in some of those markets, but when you find those opportunities, you can diversify into a new location, incredible basis with good debt and a good buy and cap rate with easy renovation lifts. It's a great opportunity for our investors to put a piece of their income into another area.
What product class was that?
I'll be in C class. I'll be in C class. Yeah.
B product for 7 cap. Boy, that's interesting.
Call it C. So there was one closer to the B, then maybe 2 that were closer to the B minus. Then it was actually 5 buildings, 7 total. Rest of the buildings were kind of in that CC plus ish area, right? So we're repositioning it back up to that B level.
Yeah, interesting. Patrick, I know you have a book that you published, and I'd love to hear about that and how listeners can get a hold of it.
Yeah, well, so I partnered up with some colleagues that I thought were just some amazing individuals. There's Phil Collins with the Def Leppard, Russell Gray from the Real Estate Guys. There's me here with a lot better looking hair on my head. I'm bald today. Some NFL, NBA players. We tell some interesting stories, and it's so funny that Mike asked me about it, but the first word is persistence on this book, and that was not planned. And persistence, pivots, and game changers, turning challenges into opportunities. It did make an Amazon #1 bestseller. And if you reach out, want to have a call, talk about wherever you're at in your journey, I believe in the contents of this book, and I'm looking for opportunities to give it away to good people. So if you set up a call and you want to do a little introduction, we'll ship you a free copy of the book. It's not a bad deal. And so Patrick at investonmainstreet.com. You can go to investonmainstreet.com/persistence as well, and you'll see the information on the book. But I'd be happy to sit down and talk about your goals and get you pointed in the right direction.
Awesome. Do I have to sign up for a free call to get a book?
You do not. No. Yeah, we'll call this good, and we'll get one sent your way.
I'll get you one of mine too. How's that?
Sounds good, Mike.
Sounds like a good trade. Hey, Patrick, 3 questions. I mean, let's lighten it up a little bit here this morning and run into the bonus round here. But favorite book you've ever read?
Well, I hate to be cliche, but it has to be Rich Dad, Poor Dad. My father has 3 PhDs. My sister is a PhD tenure track professor. I was heavily academic growing up, and to be confronted with that there is a completely different way at it, I was introduced to in my early years in engineering, did shift my trajectory 100%.
Awesome. How about best tourist attraction you've ever seen? And I know you've been around a little bit.
Wow, I wasn't expecting that one, because you're right. I've hiked the base camp of Everest, whitewater raft to the Grand Canyon, been to many of the world's countries, and slanting, I guess, that towards more of a faith-based journey. It was probably going through Egypt during Ramadan in Israel, and staying in the Church Holy Sepulchre and doing a little spiritual pilgrimage that I went on through the Middle East and Asia. That probably was the highlight. Wow,
that's pretty cool. You were in the Middle East during Ramadan, huh?
I flew to Cairo during Ramadan. My mother was not too excited about that, but I was very impressed. I traveled down the Nile and learned a lot about the faith, and I went and hiked Mount Sinai and the Sinai Peninsula, and then I traveled up into Israel and went to the Baha'i temples and Dome of the Rock and West Wall, and stayed the night in the Church Holy Sepulchre before doing the same in the Buddhist temples through China and the Southeast Asia, and spent about 10 months just exploring the faith-based parts of the world, and it was awesome. Amazing.
Were you in the service when you did that, or?
No, I wasn't. Yeah.
Okay.
I just took a break from after doing 2 master's degrees, working full time. I took a little bit of a break.
Yeah.
Mhm.
And then last question, best restaurant. This is harder than macroeconomics.
Yeah, my wife and I tend to be foodies. We actually will make all kinds of extraordinary meals. My favorite restaurant, the Prospector, this guy who claims to be the pizza Nazi, way up in the mountains where we go camping, makes these certified Napolitano brick oven pizzas up there, and it is just the most extraordinary experience every time we go.
Wow, that's
Mhm.
interesting. That sounds like something I need to put on my bucket list right next to Israel.
If I was a travel guide, I would put it as a must stop in the United States.
Wow, interesting. Well, Patrick, thank you. Any last comments for listeners this morning?
Mike, I've been so impressed by you, and I appreciate you having me on, and look forward to adding whatever value I can to your listeners.
Yeah, thank you. I appreciate that. And remember, if you want to get a hold of Patrick, you can just reach out to him at patrick@investonmainstreet.com. Patrick, I'm going to move you to the back room for a minute. I'm going to say goodbye and hang out with me for a minute.
Sure.
Thanks. Hey everybody, that was a pretty intense episode for Saturday morning. I hope you had espresso for coffee this morning, because there's a lot there, and I would just encourage you to go back and listen to that a couple of times. Remember that to connect with Patrick, you can reach out to him, Patrick at investonmainstreet.com. If you reach out to him, he'll send you a copy of his Amazon bestseller book. And, enjoy that, because it looks like a great book. That's for sure. Remember that we have the property management boot camp coming up August 18th, full day virtual event. You can find a link in the bio here. And please get registered for that. Property management is something that is not really sexy, right? And people don't talk about it enough. But it is a necessary evil of how we run and operate properties and deal with tenants and different personalities. So we're going to talk a lot about that at the boot camp, but it'll be a full day event, August 18th, start at 9 a.m. VIPs will have an early session the evening before. I look forward to seeing everybody there. Hey, everybody, have a great week. We'll be back here next Saturday morning at 10 o'clock.